Why should anyone preparing to retire buy anything other than a 30 years treasury bond for almost 5? With the 30 years hovering just below 5 also has favorable tax treatment. Why on earth would anyone buy any other investment assuming a safe withdrawal rate of 4 at retirement? The Fed has remained adamant that their long-term target rate remains between 2.5. Worst case scenario. If you have to liquidate your position, good chance you'll be selling the bond at a premium when 30 years yields are significantly lower. Inflation. At 60 years old, my why not is petty simple. I don't know that I have 30 years left. I guess no one does really. But until the yield curve normalizes, I'm sticking with the short-term rates 5.5. Once that curve reinvertes, I'll be looking at the 20 years for sure. But not 30 in my case. Because if interest rates go to 10 in a high inflation environment, those bonds will suck. If you need more liquidity for an emergency death, medical bills, etc., you'd be liquidating your wealth at a loss. When you're at, or near retirement, your bond allocation should be short-term bonds, not long-term. I'm surprised no one has said it yet. I might have missed it. But the 4 rule assumes 50 allocation to the SP 550 bonds. Once you go 100 bonds, the data behind the 4 rule becomes irrelevant because they did not backtest a 50 years retirement. Using a 100 bond portfolio. Simple answer: with inflation, your buying power will be severely eroded as the years go by investing solely in bonds. Don't want to wind up like the banks that needed a bailout earlier this year. Was just looking at 5.5 CDs. Why do 5 when you can do 12? I mean, it is just plain stupid when you see over 30 years you will be talking multiple millions of dollars in difference. Why earn 5 when you can earn 30? To be more specific, not saying you are wrong, and if you are 65 and preparing to retire, having 65 of your assets in 5 bonds is a great idea. But why give up exposure to big gains with all of it? Yes, these last 2 years have been rough. 2010 was rough. But 2021 was awesome, and so it's good to keep some risk exposure. Why not buy 1 3-month treasuries for the same or better yield? The real yield on these is something like 2.5. Nothing to write home about emo. What if people wanted to retire last year when inflation was over 9? What if we enter a period where inflation is above 5 for a full decade, like 73-83? Fed target has always been reactive and a fairy tale. Who knows if we ever see 2 in the next 10 years? We could be in a whole new era. And these 5 rates won't last forever. I think the 2 is a target for inflation. Not for interest. I don't think they have a target for interest rates. Remember when millionaire meant fuck you money? Remember just how recent that was. That's why. 5 is a decent yield. But compared to 30-year equity returns, it's kinda of lousy when you look at the total returns after decades of compounding. They are actually riskier than it seems if inflation turns out to be very hard to tame. Interest rates will rise and 30-year bonds will lose a lot of value. So you have to be very sure you'll never have to sell to eliminate that risk. I actually think there is a decent chance that inflation is going to get out of hand. If it weren't for inflation, yes, done deal. However, I think keeping a small mix of equities would be beneficial. Buy any other investment assuming a safe withdrawal rate of 4 at retirement? 4 is 4 inflation adjusted, not 4 net. Not inflation-adjusted periods like the 1966 where you miss barely at 4 real. You would be fine at 8 nominal. Worst case scenario. Worst case scenario is something else happens and the Fed is forced to feed inflation. Long-term treasuries are essentially pure duration risk. So you get completely mauled. Diversification matters. Worst case scenario. If you have to liquidate your position, good chance you'll be selling the bond at a premium when 30 years yields are significantly lower. That is not close to the worst case scenario. That is the best case scenario. As a proxy, Vanguard Extended Duration Treasury is down 22.24 over the past 3 years and with an AVG duration of just over 24 years. A single 25 bits per second hike in long-term rates would take off more than 6. Things don't always work out how the Fed wants. Inflation could go up. Interest rates could go up. If you find yourself liquidating a decade from now and rates are at 10, you'll have a significant capital loss. Add some T-bills, and they benefit in the high interest scenario, making up for your bonds. Add some stocks, and only sell them when they're doing well, and you probably improve overall returns, making up for holding T-bills if rates go down. To whatever extent you have to sell things, sell whatever's doing best. Inflation. 2-3 inflation over stable years, but how many times during 30 years will inflation be above that? Also, that's the combined inflation for everything. Everyone has noticed that inflation on necessities like food and housing far surpassed that. 2 years at 5.2. Why risk the extra 28 years for no benefit? 30Y carries significant duration risk. Laddering bonds would be a much better strategy. If you aren't buying TLT at these levels, I don't know WTF you're doing emo. Because of the risk of inflation. Look at the crazy politicians we have in Congress. They keep threatening to default on the debt. There may also be a war or a pandemic. The debt keeps growing and there is little hope of raising taxes on the rich and cut the defense budget. It is an inflation time bomb unless something changes. To manage risk, you need to diversify real estate, solid stocks with pricing power, international stocks, etc. One word: inflation. 5 is really a 2 real return assuming we have historical average 3 inflation. Because if you retire you will need that money way before the expiration. In 30 years you will be likely death. What if inflation is 20? You don't need money when you get to retirement, you need it through retirement. If any of the money is in 401k or IRA, need to plan for RMDs. What is the favorable tax treatment on treasury bonds? Take a look at the 2-year chart of TLT, and you'll get a better idea of what can happen to the real market value of those bonds. And just because the Fed says something doesn't mean it's going to happen. There is no reason to buy nominals here over tips. Buy a 2.5 real yield and be protected. I don't trust the Fed for a second. Why do 5 when you can get 10 in the stock market? I remember when interest was 15. Why lock in 5? A 5 coupon or 5 APY. Long bonds ain't paying 5 coupon. They have 5 yield, which is great but might lose value if rates go up even more. B. Inflation. C. You really think you're doing great if you are making 5 when the market potentially is going up 31 year? Do you have any idea how many years of compounded 5 growth that is? I'm not saying the market is up 30 this year, but it might next year or the year after. It's not that your question is bad, but it's that the answer is there are many reasons. These were only 3.